Hope everyone's doing well. I'm going to make a video that reviews the past year or two of FOMC days. And the reason is, I think it can be helpful going back. I want to talk about it, and it can be helpful going back several years and just showing that nothing's really changed since then. So here I have a chart of January the 30th, 2019, and you can see on the first bar, we had a very big outside up bar, and the funny thing is this bar is only 20 points tall. No, I'm just kidding. It's actually, it's about 20 points. So a lot has changed since 2019, but you can see on the first part of the day, opening reversal up, we channeled down and we got trend resumption. But more importantly, you always ignore what's happened prior to the FOMC. The first bar will always tell you what's going on. So big bar, outside up, it's buy the close bar. Buy the close, buy a pullback. You can buy above this bar, you can buy above this bar. Stops far, but you're probably going higher. It's also important to realize that this is not most FOMC days. Usually you don't get a bar this big that continues to rally. So let's go to March the 20th. That was the next one. So 3/20/19. Here you go. So similar pattern, but very big bull bar, bad follow through, sideways rallied. So somewhat similar to the prior day. Bear channel, but either way, very big bull bar, big enough surprise. Probably going to get a couple legs up. Here, you can buy above this bar, it's buy the close. Started to go sideways, second entry short, maybe a wedge, 1, 2, 3. Bulls get out, and aggressive bears will sell. When you see this bar, it's big enough surprise, making another leg down, and then somewhere it became sell to close. Bulls tried to form a double bottom at the moving average and broke to the downside. So let's go to April. Looks like April was the next one. Maybe not. Oh, it was May the 1st. That was so May 1 of there we go. So here, a little bit different of a day. Broke to the upside, so here's the FOMC bar, and what do you notice? This bar is not huge compared to the other bars. So, big bull bar, probably going to get a second leg up. You can buy the close, but can be dangerous because it's often the first bar of the FOMC reverses. Doji bar, probably buy the close, going to go a little bit higher. Disappointment. Some bulls will buy, they'll be disappointed, they'll scalp out, betting bad follow through. Bulls bought this close, same thing, disappointed, outside down. Some bulls may give up below it, betting that we sell off. It's kind of a double top, up, down, up, down. Same thing here. Bulls still trying to get out break even, and they gave up. Sell the close, but huge bar. Probably, you got to be really careful, stops far, and you can get that. And if you get that, traders might panic and try to get out back at the lows. And you can see what happened right there. Bear sold, scaled in, got out up here. Do you buy this close? You can, but it might be a two-legged trap, and it could be a second leg trap, and bears may sell up here. Bears sold this close. Some got out break even. Others just sold more higher, low too short, and they sell. So if you're a bear, I'm going to sell here, get out, maybe scale in, get out break even, sell again below here, betting we retest, and we went lower. So you can see just how quick, this bar is big for this range, and then you get this. So let's go to June the 19th. If I can get my days right. And remember, we're just in 2019 here. So here's a great example. So big outside up bar, huge bar compared to the prior bars. This bar is massive compared to this. So let's go back a month for just a second. Remember this pattern, and this is June, so let's go to May real quick, and let's look at this. This bar, not nearly as big, so it's not as climactic. March 20th, again, not as climactic, but when I go to June the 19th, huge bar. So bulls, buy the close, disappointed. Guess what those bulls are going to do? They're going to try to get out break even. Some got out break even on the entire trade, others trying to get out break even here. Sell off might just be a second leg trap. Bulls will buy here. So bulls, some got out with a small loss. They'll buy again, betting we're going to test here. Boom, we tested there. But what do they do right there? They're so disappointed, they're going to get out at break even, and now we have double top. And some bears will sell below. Other bulls will, just one moment. So some bears make it out, but big bar, big risk, and you might get that. So now we have a wedge, 1, 2, 3, and again, this is becoming a mess. So 1 push, 2 push, 3 push. Bears may give up. Bulls may give up there, and there you go. So that's June. Let's go to, I'm going to kind of fast forward a little bit. Let's go to the 11th of 2019, and there you go. So here's the day. Rallied, deep pullback, but again, outside up bar, big enough surprise, probably going a little bit higher. Some bulls wait for follow through, it's buy the close, probably going higher. Disappointment, but not enough to sell. Big bull bar, so again, still no reason to sell yet. Follow through, and maybe it's a wedge, 1, 2, 3, but channel's still pretty tight, probably going sideways to up. And some bulls will be disappointed with that, get out break even, outside up, pause, and eventually buy the close bulls are going to start getting out break even. So buy the close bulls they bought, scaled in lower, they'll get out break even. And there you go. So we went a little bit higher, sold off. That doesn't mean we're going to reverse down. It just means we may start going more sideways and eventually convert to a channel. So 2 legs down, test the bottom of the channel, and probably still going to test this close. And, there you go. So even though we took a while, we still tested the close. Because trends evolve into trade. They evolve. Breakouts form channels. Channels form a trading range. And then trading ranges probe up, probe down. And, I'm sure we broke to the downside at some point. We don't really see it here. So now let's go to, I'm going to just kind of go to a random day. Let's go to March the 18th of 2020. This might be more of a, what am I missing here? Huh. Interesting. I can't find March. Let's go to April 29th of 20. Let's try July 29th, 2020. Here's a Fed day. Looks a little more inconspicuous. So, channel up, big outside down bar. What do? Well, we're holding above the moving average. I need more information. Big bull bar. Still always in long, but doji, bull bar. You can buy above it, taking a chance we rally. I'd rather do that than selling, but still no information. Some bulls will buy and get out break even. Others may hold. And, again, we're just forming a micro channel, buy the close. So at this point, more traders will buy. Consecutive bull bars, probably going to get a second leg. There's a bar, pause, and boom. So let me kind of try to make this look a little cleaner. So it's also a parabolic wedge. 1, pullback, 2, pullback, 3. disappointed bulls, and then you have a bear bar closing on its low. If you did buy here, probably get out below that. If you didn't, you get out during this bar. Consecutive bear bars probably sell the close, but testing the bottom of the channel may just get a small second leg down, and you didn't get a second leg down. So this is the day that will mess a lot of traders up. So let's focus in more on it because it's a little more confusing. So trend from the open, and so far, most trend from the opens do form trading ranges, but since you're supposed to ignore the FOMC, you're supposed to ignore the prior bars to the left when looking at the FOMC, take that with a grain of salt. What I more so mean is pay attention to the first two bars of the report. Overlapping bar, probably trading range. Inside bar, bulls may buy, but that's disappointing. Then you get a push up, and then you get a second, third. So, is it possible this second leg trap? Sure. Then you get an inside bar, and you get a big bear bar. Is it sell to close? Maybe. Maybe it's sell to close here. But when you see that becomes dangerous. So a lot of bears would probably get out above that bar. And if they didn't, maybe they get out there. And that's where they become trapped. So now it becomes buy the close again. And we go higher. And really sideways into the day. So, it can be. And another thing just to point out is it's a lot of risk on the. As strong as that sell-off looks, let's do this. Maybe we can look at an SDS, an inverse of this day. So this is the opposite of the FOMC of the E-mini. Same day. Outside bar, inside bar. You can sell, hanging below the moving average all day. So far, good for the bears, but it might be exhaustion. And bulls looks like they're winning. Bears are giving up, so you can probably buy. Second bull bar, and then boom. So it's possible this is some form of double top. Break below the neckline. Probably won't happen, but it might. Bears trying to break below the neckline. Couldn't quite get it. I do want to see, more of curiosity, if July the 30th of 2020, see what that did. So, big gap down. So, anyways, I don't want to go too far into this day. Point is, there can be a lot of confusion on the FOMC days. And, again, it's kind of like a new open of the day where there's an increased risk of the breakout failing and reversing. And you can see we came right back to the start of the FOMC here. So let's go to, let's go to December 16th, 2020. I don't see why. Let me see here, one moment. Here we go. So I went to 2021. This is June of 2021. And June 16th. And this is data on the SPY, but you can look at here's the E-mini. So, selling off. And big bear bar, big risk. You can sell the close. Again, not ideal to sell the first bar because of that. Big bull bar, but again, big down. May retest the low close, and we did. Some bears, maybe they'll sell below that. But again, this is just a warning that this is not going to be, you're probably not getting a measured move up or down. And most bulls probably want to look to buy some sort of double bottom. Always in bears, probably get out above that bar. Too much risk of an upside breakout. And what do they do there? Well, that's a problem because it may form a wedge, may sell off, and we're selling off now. So bear breakout, a couple legs down, another bull bar. This is not good. But the bears are holding below the moving average. The bulls need to get above it. So again, not ideal to buy above either. 3 consecutive bull bars. Maybe some bulls will buy there, betting we get to the moving average. Might be buy the close, so it's a reasonable buy, betting we rally. Trying to break above, and we broke above. So now probably buy the close and going higher, and we broke above here. Now, this looks easy. Breaking above the moving average, that's great. So it's probably going to go even higher, and we tested this high, and we went sideways into the close. But you got to avoid all of this, and that is a challenge. Let's go to January 27th, 21. And the most important thing people can do is, I don't know why some days, I'm going to go to March 17th. Go to March 17th, 21. There we go. So big bull bar, big risk, 50% pullback. Some traders, maybe you can buy the close, bet it will get up to here, but not ideal. Probably better to wait for a stop entry. Consecutive bars, you can probably buy that. Another big bull bar. Again, it's probably by the close, but again, big tail, so may just go a little bit higher. Bear bar, disappointment. Possible 2 legs up, big bar, big risk. So a lot of traders may try and get out at the high close. And there it is. So, and that's another problem with FOMCs is you often can have deep pullbacks. So this is 2 large legs up, it's higher high, major trend reversal in a smaller time frame. So if I got like a 2-minute chart, 2 legs up. If I go to, there's the 5 minutes, so tight channel, deep pullback, test of the moving average, and double bottom, bulls buy, and then bulls buy above that, and then we lead to a second leg. So personally, I would just be cautious because it's just really easy to get chewed up on the FOMC when it's released. Try September. There you go. So outside up bar, and we got a second leg sold off. So hope this helps. In general, traders should wait for the first 2 bars because there's too much risk of a lot of overlap, and you often go sideways on the FOMC. Least likely, you get a big trend bar and you race up, big bar, and then you just race up for the hour. It's not that common. Hope this helps.